Okay, traders, as requested, I'm going to run through the portfolio again and just explain how it works. I just had a few requests from members to just run through it and really understand it thoroughly. So it's pretty easy. This spreadsheet's all automated and it's working off the starting capital of 100,000, which is what you need to trade the large S&P. So we have our key equity hedge is the name of the system, and there is a spread component, an options spread, and a futures component. It's traded on the S&P, and the underlying futures market is the S&P 500, and the spreads are the large S&P. So we set a spread, and during the spread period, we have to hedge that in case something goes wrong in the options, whether there's a major rally or a major sell-off, or we've got it covered on the futures side. So it's pretty simple. So we set a spread on the 29th of December. We can only go into an options trade when there's a futures trade that sets up, because you need that instant protection in case something goes wrong with your options trades. You need to have a futures trade in there to hedge against that. So it pairs with each other. So one is no good without the other. So we get an futures trade on the 29th of December. So we set a spread which expires on the 20th of February. So from the 29th of December until the 20th of February, we've got to hedge this spread. So we have to take every futures trade that's set up in between then. So we've got our futures trade, which is this indicator. So it's a simple indicator which you get with your system. So green cross means go long and hedge against the market. So as it starts to rally, well, we've got it covered in case it really takes off. So we've got to make sure that we don't blow an account up, which is consistent with what happens with a lot of option systems. They don't have that protection. It might go well for 4 or 5, 6 months, but then bang, you've got a major step backwards. So with this hedge, you've got yourself covered. So green cross go long, hedge, and your stop goes underneath on yellow dots. And the same thing with the short. See how that market sort of rallied up there. So we're long the market there. We're making some good profit. I'll explain how that works shortly. And we got the same thing with a short. So you get in short, red cross, and you got your stop above, so you've got it covered when the market sells off. So we've got a hedge using that futures indicator. 29th of December is when we got in the spread. So we've got to add up all the futures trades between 29th of December to the 20th of February. So you're tracking your own spreads and your own trades, and this can be used as a reference point. So we start with 100,000 bucks on the 29th of December. We go down and got cover till 20th of February, which is a pretty lengthy spread, but that's okay. So during that period, so we've got a pretty long spread there for short-term spreads, and we've made 29,000 on the futures. That means there was a lot of movement. So we've made a 30-point move there, a 58-point move there, but we have landed inside our spread, the strike points, so we grabbed $6,500 there. So now, once that's finished on the 20th of February, we can set another one when we get a futures trade. So we get a new futures trade that starts on the 20th of February, so we can set our spread, and we pull in 3,230 on the spread premium. So now we've got to hedge that trade with our futures. So we got to cover it till the 17th of April. So 20th of February to the 17th of April. Let's go down to the 17th of April and see what we made on the futures. 17th of April's there, 14,800 plus your spread. So we're making some pretty good returns. Volatility goes out of the market in April, so we're getting less for our spreads. So 20th of April we get to set a spread, and this one goes to the 18th of June. So we got less premium on the options trade. So let's have a look to see where we go. 18th of June, 20th of April, 18th of June. It's a bit shorter time frame. We make 1,250. So we're still up. Not a lot, but we're consistently making profit. 1,250 plus 3,000. So we've made another good profit. Now we get a spread which goes against us, and we lose money. So what would usually happen with this is you'll lose, without a futures hedge, you'll lose 5,500, which is what this options trade has lost. And it goes from the 18th of June to the 21st of August. So 18th of June to the 20th of August, 21st of August is what the futures made. So 10,787. So 10,787 take 5,500 loss on the options. You're still up because of your futures hedge, and that keeps going on and on. So you've got a paired option spread with a future spread. This one's 2,300. So 16th of October till 25th of August till 16th of October is you are up $1,000. So futures covered that. So you're up $5,000. Got a live trade at the moment. So 19th of October till 17th of December. At the moment, the futures have pulled in 1,125, and the options trade is live in the market. So we can have a look at that. Let's have a look to see where it is. It's coming up here. There it is. So that's when we entered the trade. These are our strike points for the options. That goes into more detail of how that's set in the option strategy. So we want the market to land inside this blue line and above this red one. So we are dead smack in the middle again still, and we've got another month for this spread to expire. So that's where we're at the moment. We're 42% up on the $25,000 account, 55.5 on the 100. 500 grand is 55% up, and $1 million accounts again 55% up. So that's since January this year. So 2008, we're traveling okay at the moment. So thanks for listening, and we'll catch you again tomorrow for the next update.